morning, everybody. It's Wednesday, November 15th, and this is the Ag Yield War Room. My name is Dan Dempsey, and I'll be moderating today's session. As always, if you've got any comments or questions, please feel free to enter those into the chat function, and we'll be sure to address those throughout the session. Quickly, overnight markets had December corn down 2.5 at 475 3/4. January soybeans down 1 1/4 at 1388.5, and December Chicago wheat was down 2.5 at 569.5. This morning, the USDA announced the sale of 124,000 corn to Japan for 23. And a couple of things to point out: we'll have notebook crush out here at 11 o'clock, looking for a record at 187.2. To kick it off here this morning, we've had Brazilian weather as a catalyst for pushing soybeans to new highs. And I know, Dustin, you had a few thoughts that you wanted to address here this morning.
Yeah, thanks, Dan. We are looking at a rising bean market. Obviously, a lot of interesting things are happening to bring prices up to where they are. So we've got huge premiums in old crop beans over new crop. So certainly you're looking at profitable levels of making that next sale. But also for Nov 24, traded last night at 13.15 1/4. And we're just looking at some, this is the time frame for us. And there's all this excitement about what could happen in Brazil and why prices are rising. Some very unique commercial products that we're looking at, ways to start actually setting that price for next year. Even looking out to 2024, we know we're going to look at probably quite a few bean acres if prices continue to rise into that planting decision window. So I think just bringing some light to that subject, that now is the time to be considering that.
That's very good. And as we were talking, earlier this morning, it just seems like we've got a lot of good things on the radar right now for beans. There's the potential here for some really cool things to be done. As you look at it relationship wise, I know we're always looking at corn and beans as a relationship. I mean, what are your thoughts there, Justin, so far?
Yeah, I mean, we talked about it a little bit yesterday as well, but these ratios, the bean price divided by the corn price, right? It's generally a good indicator of planting intentions, right? Which crop is going to be favored to gain or lose acres. And, right now we're about 2.53 in the new crop. So usually anything over 2.5, you start kind of getting into that switch mode. 2.65 I think is the highest I've seen it, pre-planting. That's when it really matters, right? When you're planting the crop. After the crop's planted and all those things are done, the ratio really doesn't matter until you get into like South America or something like that. So for instance, like we're approaching 3-to-1 in the old crop beans. Really doesn't matter, right? You've already planted it. You've already got the supply. So the ratios are kind of irrelevant for the old crops. But where it really starts to matter is when it starts dragging up those new crop ratios, where, we like to get aggressive when those ratios are, at the high level, getting more aggressive on beans. For those of us, for those of you that have followed for a long time, when ratios were in the low 2s, we were much more aggressive on corn sales and, getting upside with soybeans. So again, I think it's just another tool to look at, where's the best value. If you're looking at, Dustin says this a lot, total farm coverage, total farm revenue, where's the best area to put some money to protect downside, right? In our opinion, it's approaching beans rather quickly. And so you always want to be cognizant of that and think of strategies and what tools fit best in that kind of environment.
Yeah, and if I may add to that too, if we think about total farm revenue, like let's just say this especially applies to 50-50 growers that might be, split corn and beans down the middle. Let's say, at this time of year, maybe we want to get up to 30 or 40% sold. Let's say it's 40% based on how much we've locked for input costs. One way to do that may be to move to 20%, 20% or 30% in corn and more like that 50% in the soybean side. And obviously various ways to get to that point, using cash products, unique things that still allow for some upside open. But the percentage of floor coverage, we would want to be greater towards beans when we just had a very large corn acreage number in 23. And we think we could be more evenly split for acres in 24 between corn and beans. So all that excitement in the ratio for the 23 contracts, we do believe it's kind of bleeding over to the 24 ratios as well. And that provides opportunity where we're seeing pretty good margins for NOV 24 soybean growers on our end. And we want to try to protect that.
Yeah, and another thing too, just like talking to psychology for a little bit, and this has happened for a lot of years, but growers tend to plant what they should have planted the year before, right? So in their mind, like if soybeans seems like it has a really good story and it's got a high price, like you tend to get a bigger switch than normal, right? Because there's, biodiesel, whatever the story may be, China's really buying right now. So I think from a mentality standpoint and price standpoint, like I think that's, the more bullish that a South America situation might turn for soybeans, the more bearish new crop beans could be here, right? So I think that's kind of important. Is a lot of people plant the crop that's exciting, but forget to hedge it, right? And so the advantage of those prices and that opportunity is actually doing something about it, right? And you can, sometimes do some hedges and put some, length back in the market through call options or whatever, maybe even in the other crop, like a corn crop in this example, where you feel like you might miss out. All those kinds of things are, to Dustin's point, different tools you can use. The point is having a game plan and looking at how it's actually going to fit in the farm.
That's a great point, Justin. And I think, that also lends itself. I mean, the fact that, today we've got President Biden meeting with President Xi, so as exciting as different things are happening, I think we still have to be cognizant and prepared of, any changes quickly in our markets, right? Who knows what could possibly come out. And that's the beauty of AgYield, is being able to plan for those different scenarios within the software, which, Dustin, I know you guys are running quite a few scenarios out even for the new crop for your clients right now.
Yeah, we can get preliminary cost of production in place. We want to keep it to a margins based. A lot of what we're talking about in these meetings is going to be, market opinion. We can shape market opinion around a margins based approach still, right? Like even if something happens, that U.S.-China relationship turns sour for some reason and prices start to fall, we've got some of the minimum, revenue targets locked in that we needed to have.
That's very good. Ryland, looking at the meats real quick here, I noticed yesterday we had fats and feeders close a little bit higher, but still not an overly friendly close. So what's your thoughts?
Yeah, Dan. Yeah, we closed. We tried to rally the cattle market early. I think everybody's looking for some kind of optimism. It's just we got the cattle on feed report looming. I mean, no question about it. All the eyes are going to be on the placement number because that was the big shock. Supplies just up front really aren't as tight as I think the market was led to believe pre-report. So if we see any kind of record placements or even record on-feed inventory for November, there's still some pretty serious downside risk here. But generally, I think trend is obviously negative. We saw beef prices dip pretty hard yesterday. Choice was down $2. Select was down $1.30. Load counts are starting to pick up a little bit too. So we are seeing some good volume at this stage of the game, at least in the beef. But we really don't typically seasonally bottom here until kind of early next week. But it's a coin toss. It really just depends. We're at historically high price levels. Staying hedged in these environments are absolutely imperative. If you just compare this year's price to last year's price, it's pretty huge at this point. So we just want to stay vigilant, stay hedged. In hog market especially, the seasonal trend is definitely lower for cash. We're sitting around 63. There may not be that much more downside from cash, but futures are carrying this pretty hefty premium. I think it lends itself to maybe using the board to hedging for those that still kind of need it in the upfront market. So we're looking here possibly for a little bit of a bounce here into next week in cattle. I think that for those that are really heavily sold, maybe look at some call options, just something cheap. They've really destroyed volatility, and calls that people were looking at a week ago are considerably cheaper. So I think that's something just to keep the focus on. But right now, all eyes are going to be on any kind of changes with Xi and Biden, if there is some kind of trade agreement, to see if the export market really starts to get rocking here. Other than that, yeah, well, it seems like we're kind of at a little bit of a negative kind of stance right now just ahead of the cattle on feed report.
Are you still seeing pretty good LRP type opportunities in the cattle markets, Ryland, as we go into cattle on feed?
Absolutely. Yesterday was a good example of a close that typically works to structure some LRPs. Being the sales open up right around 4 o'clock. So if you get a really big up here before that that cattle on feed report on Friday, may want to meet up and talk about getting some more LRP coverage for further out, especially April, maybe even into June timeframe, as we look in the cattle market. And hogs, same thing, Feb and April. I think it's pretty imperative, especially if we're looking at kind of a rougher economic headwind situation going into next year with all this talk of recession.
Very good. Appreciate the update, Ryland.
Thanks,
Ben, what do you got for me out in the East this morning?
In the East, still things are moving pretty slow here. Processors are going to have to dig us out. Just a massive crop in the East. Basis getting hammered, 45.50 under. I don't think that'll last too much longer. I think we've probably got 15 to 20% left to go of harvest. Just going to add into the bean conversation that I think the timing of this becomes really critical, because we could incent a tremendous amount of bean acres and realize that at about the same time that South American crop comes to fruition. And if we remember last year, I think we broke almost $3 in beans off those highs down to 11.30 or 11.40. So it does definitely warrant kind of sharpening the pencil and looking at soybeans here over the next couple of weeks.
Perfect. Thanks, Ben. We've got about 4 minutes to the open here, guys. Anybody else? Parting shots, comments? Like I said, got a couple of pretty interesting news pieces that'll come out here today with Crush and certainly any highlights out of the presidential meeting. So, parting shots for guys.
Yeah. One thing I would add is just the outside markets. The dollars having massive moves. The market's really trying to figure out what this means with interest rates and bond markets. The bonds are moving a lot. Stock markets are, had a big move higher. I mean, we're closer to all-time highs in some of these stock indexes, like the NASDAQ, than we have been for a long time. So there's a lot of money moving around. There's a lot of big players that are, I'll call new, but new being the last, 10, 15 years, especially to our markets. They have big positions now. They move money. They don't necessarily think of our markets like we do. We're trying to fine tune a Brazilian crop that's still being planted. They're looking at big macro, things. So even more reason to, I think, really, know what your game plan is here, just in general, whether it's trading or hedging, because these things can move so violently. Oil share is one that we talked about yesterday, but moves that we haven't seen in decades, really. The speed and the violence of some of these moves are pretty astounding. Right now it's in our favor, in the soybean complex, for example. Right. So, just to be, mindful that it can be the opposite, and it can do it for reasons that we don't know sometimes. So just to keep that in mind, like take advantage of the good times, and these things they change faster than they used to. So.
Yeah, Dan, on that front, Jason and I were talking a lot about this yesterday, actually, is that, if you're wondering what's happening in the soybean complex, a lot of times you look to what the Brazilian real dollar spread is doing, and there's a huge correlation with that right now still. Like even overnight, there was a fairly large rally and drop in the real corresponding directly with that same move in the bean market overnight. So that's another thing just to maybe keep on your radar if you're watching it very closely. The other thing too, we talked about the corn option net changes. Again, we are at a pretty large difference. Average put in the money put is at a 512 strike on 151,000 contracts. So that's 750 million bushels there. Again, another drop a little bit in that put call ratio to where we're about 129,000 net after yesterday's open interest change. So still favoring way more in the money put options than call options, something that, it's an underlying potentially supportive factor. There's a lot of negative factors too for corn, but one potential supportive factor is still in the option market.
That's very good. And Dustin, in a real quick, brief synopsis as we open here, give us, a rallying real versus a breaking real, what that means to our listeners.
Well, yeah, in theory, like the real is rising, right? Their prices are falling, right? Because it's becoming more expensive for importers of Brazilian real or of Brazilian soybeans to buy from them. So their local prices start to fall and they become less willing sellers. So we become more competitive, right? And vice versa. Falling real, their prices are exploding. They're much more willing sellers when their prices are locally rising and they become more competitive. So, especially when there's actually product to compete against, it's something to watch. And we'll have that in the nightly letter tonight, just to show some more visuals of like how that, especially over like a shorter period of time, like a 3-month to 6-month window, you can see a huge connection between beans and real on a correlation.
Good stuff. Very good. Well, we just opened here, everybody. D's corn's down 2 1/4, 476. January beans are up 2 pennies at 13.91.5, and Chicago wheat's down about a penny across the board. Appreciate everybody tuning in this morning, and we look forward to talking to everybody tomorrow.
Thank you.
Thanks, Dan.
Thanks, Dan.